now only have a loan for $50,000. That's okay to do that, but you're going to pay tax on the difference. So you don't have a fully tax-deferred exchange. And that's why talking to the tax advisors first, having your client talk to a tax advisor is the best situation so they know exactly what they need to replace with, okay? So there's crazy rules, I call it, when it comes to 1031 exchanges. And one of the crazy rules, of course, is the identification rules, right? Everybody's like, okay, now what do I do? So there's 3 rules. Then you have the 3 property rule, and what that means is that you can identify 3 properties, and it doesn't matter what the value of the properties are. And you only have to acquire 1, as long as it meets your equal or greater requirements, right? But if you want to identify 4 or more properties, it hops into the 200% rule. So what that means is if you identify 4 or more replacement properties, the total value of what you identify cannot go over 200% of the property you sold. Okay, so you got to start doing your calculations. Then if you do go over the 200%, then there's what's called a 95% rule. And the 95% rule says that if you acquire 95% of what you identified, you're okay. Okay, so these are the identifications. So 3 or more properties identified, you're good to go. You don't have to worry. But once you start going into 4 or more, then you really need to watch your numbers. That's the thing there. The suggested holding period for the exchanges is 2 years. If you want to exchange with buy from a related party, be very careful because the related party also has to be doing an exchange. So that's why you have your tax advisor, okay? Because if you're selling your property to a relative and your relative turns around and sells that property before 2 years, it jeopardizes your exchange. Okay, so that's why, like I said, Anita and other tax advisors, they know what to watch for. Okay, I just had a client sell his business to his brother. Okay, so those are the things you need. And I know that you guys can't give tax advice, right? But you need to at least say, hey, you need to watch this and make sure you talk to a tax person because none of us want to be the tax advisor. That's what Anita's job is for, all right? So relatives are brothers, sisters, spouses, ancestors, and lineal descendants. Related parties are not step-parents, uncles, aunts and uncles, nephews, and ex-spouses. So if you take any cash from a 1031 exchange, you will pay the tax on that cash. They call it boot, okay? If you want to convert your an investment property to a primary residence, that's what everybody says, oh, I'm just going to move into my investment, live in it, and then turn around and sell it, right? Be cautious with that, okay? Because you must own each of the properties for 2 years. Then when you go to sell the primary residence that came from a 1031 exchange, you must be on title for at least 5 years. The longer you live there, the bigger the proration gets. However, the recapture from depreciation doesn't go away. So to illustrate the change, let's assume married taxpayers exchanged into a residence, rented it for 3 years, moved into it, and then lived in it for 2 years. The taxpayer then sold it and realized a gain of $500,000. The exclusion would be prorated between the qualified and non-qualified use. The numerator is the period of non-qualified use and the denominator is the number of years the property has been owned. So 3/5, 3 out of 5 years of the gain, or $300,000, would not be eligible for the exclusion. And 2/5, the 2 out of 5 years of the gain, or $200,000, would be eligible for the exclusion. As a consequence of the taxpayer would pay taxes on the $300,000. So again, this is why I'm saying talk to a tax advisor. Make sure they know, they advise the clients and let them know that what their tax liability is going to be. Because everyone says, I'm just going to move into it and I'm going to live there 2 years and I'm going to get my $500,000 exclusion. Okay, so be careful with that. Okay, so the most common reasons exchange fails, and some of these are kind of hilarious at the bottom, but not enough inventory, right? We ran into the market just not too long ago where it was very hard to buy your replacement properties because of the multiple offers. Inability to qualify for the loan on the replacement property. Now, as a credit repair person also, I got many phone calls because people lost properties or chose to walk away from properties in this last market, and now they want to do a 1031 exchange, and they can't qualify for the loan to replace the loan. Okay, so that runs into a problem there. Sometimes they can't find a property that was good as the one they sold. Okay, so a lot of times they'll end up with the property and they said, if I would have known what I ended up with, I wouldn't have sold what I had. Okay, so that creates a problem. We've had situations where the replacement property burned down in the middle of the exchange. Okay, so that's why I never suggest identifying just one property. But again, there's a reason for the tax advisor, right? We had a seller that we were buying a replacement property, and the seller went in the hospital. The deal kind of went dead. We couldn't finish it. Okay, so there's different things that could happen. I had a client that currently works for a startup company, so he doesn't have an income, right? Because he's been working with the startup company, so he can't qualify for the loan. So you really got to find out what your situation of your client to fit him to the next, actually to the right situation. All right, choosing a qualified intermediary is very important. You need to choose an intermediary that is bonded and insured. Of course, all of our title companies have intermediaries, and they're very good. And there is the strength there. You can also, with the independents, there's second signature accounts. There's restrictions to them, but there are ways to help secure the funds there. And we work with attorneys that have been the top ranked attorneys in the top 10. And have actually written laws in that. And so like I said, a lot of the qualified intermediaries, the title company ones, you don't really have to worry about them. Actually, I shouldn't say that. I worked for one of the title companies intermediary, and they actually ended up closing down after I had left. But what was happening there, and they do have the strength, but what happened there is the person that ran our treasury department for the title company was investing the 1031 exchange funds. And he ended up taking losses on the exchange funds, right? But because it was a title company 1031, they could cover the losses. So that's why you got to be careful with the independents. Make sure what they're doing with the funds, and make sure that they are secure. Yes? The second signature account is that some intermediaries will allow a second signer on their bank account, but it cannot be somebody that is a relative, and it cannot be somebody that the taxpayer has hired in the last 2 years. So I had a situation where one of the exchangers added a person from Wells Fargo on the bank. Okay, so they added them as a second signer because there was no relationship. You can't make it where you work for that person and they can instruct you to sign the funds. You don't want to have constructive receipt. So, but there are ways to put somebody, I always say it's almost like a buddy, like a good friend. You know, they never worked for you before, they're not your relative. That would be somebody that could go on to the bank account. So when the money needs to be released, that person needs to sign also. So the bank will make sure that there's the two different signatures to move the money. Okay? With the title company 1031 intermediaries, you don't have to worry about that. You know, they have a lot of backing, but independents, you want to make sure that you're comfortable as far as them holding the money. So do we have any questions on 1031 exchanges? Anita, is there anything you want to add?
Just like Ruth and I were talking about, comparing horror stories. There's
Yeah.
one way to get a 1031 right. There are a million and infinitive number of ways to get it wrong. And it's amazing the things that come up in real life that you never think about, but they occur. For example, I helped with the 1031 exchange a couple of years ago. And the person identified the property, identified it, they'd gone up to the county recorder's office, written down the addresses. Well, it comes out that during the 1031 exchange, one of the neighbors, his father had passed away, and he was OCD, and so he took out all the documents, and somewhere 50 plus years ago, the APN numbers got switched. And it affected this whole block, including the identified property for the 1031 exchange. And they worked with the county, got it all sorted out, but the problem was when they went to close the 1031 exchange, the identification APN did not match what the actual APN was. You would think the IRS would be reasonable. They actually opened an audit for the case. IRS is never reasonable.
No.
And so we actually end up in litigation over this, and the taxpayer prevailed. But these are just some of the things that come up in the 1031 exchanges that can have a significant impact, or the person passing away, or being in some type of catastrophic injury. And, you know, the people that are supposed to make the decisions in their place are very hesitant to do so.
Yeah.
So it's
And I had a similar case. I had a client that identified a replacement property according to the flyer that was given to him on the property. Well, the address on the flyer wasn't right. So when he went to buy the replacement property, it was a property that was on a corner. Okay, so it had 2 addresses to it. So he only identified the one, but the title company only had the other address on it. So there's so many things to just watch for. And in the pressure of the timing on a 1031 exchange, you have to be ready. So make sure, like I said, yes.
What were the percentages again for federal, state, and Obamacare? Do you remember those?
Federal could be 20%, state 13.3, and Obama's 3.8.
Now, you said
Net investment income tax is the proper name, but we call it Obamacare. What was the word?
You said could be, so they could vary?
Yeah, it depends on your income bracket. This federal could be 15%, 15 to 20%. So that is another reason, talk to your tax advisor, right? Make sure you see what's going to be happening with you. But from what I find, when they sell property, especially here in California, they're all in the 20% bracket, even if they were in a lower bracket before. You had a question?
Can you explain the identification for or more properties in the
Yeah. and I have, so I know I'm trying to cover 2 different things kind of quickly, but if you guys want to give me your card, I can send you a presentation that has I have a 1031 complete presentation I can send to you, and it's all spelled out for you. So I'd be happy to share that with you, okay? But the 200% rule is if you identify 4 or more properties, and the value of those properties goes over 200% of the property you sold, the total value. So if you identified 4 properties and the value of all 4 combined stays within the 200% of what you sold, you're okay. But if it goes over 200%, then you hop into a 95% rule. And that's where it says you have to buy 95% of what you identified.
Meaning
Okay.
95%
Of the value. The total value of what you identified.
So all 4 combined?
Uh-huh.
So 90.
So you almost, so basically, if you identify the 4, you go over 200%, you better buy all 4.
All 4. Okay. Wow.
Yeah, so you have to really watch. Identification is what can trip you up. Anita, all the time, right? All the time. Identification, you gotta make sure you understand the identification. And that means making a phone call to us. Okay, we can help clarify it. Okay, this is what my client sold. This is what we're gonna buy. Does it fit? Okay, and then a lot of people will say, well, what should I identify? Should I identify what I'm going to offer? Or do I identify what the asking price is? And then what do you do when you identify and you end up spending $400,000 more for it, like some people did in the market just not too long ago? You know, what are you going to do? You know, what are you going to do with that? So the easiest thing is identify 3 properties, and you don't have to worry about values. Okay, but if you need to do anything more than that, be careful. Be very careful. Okay, so now we're going to talk about how to rescue the exchange. Okay, so you can defer the tax but keep the cash. Okay, we're talking about a tax-deferred installment sale. People know it as a seller carryback. Okay, that's what I'm talking about. The laws for installment sale have been around since 1913. So Remember I said 1031, 1921. These are a long time, okay? And then we're coupling it with a tax-free monetization loan. So we're going to walk you through a transaction. And like I said, at the end of the day, at the end of the presentation, if you guys want to give me your cards, I'd be happy to share the presentation with you, okay? So let's go back to the 1.8 million commercial property, and you have a buyer for the property. So the capital asset dealer steps in the middle of the transaction like a 1031 exchange intermediary and buys the building from you under an installment contract, okay, from the seller. So they're going to enter into an installment contract. So nothing new about the installment contracts. They've been used forever. It just means a promise to make payments. So what's unique about the installment contract is that it's for 30 years, interest only, with the principal of 1.8 million due in 30 years. So that's the key. You're not going to get any principal payments, only interest payments for 30 years. So by paying interest only for 30 years, you've effectively deferred your capital gains tax for 30 years. If they had paid any principal, it would have triggered capital gains tax. So they pay you just interest and you have 30 years tax deferral. So now you have an interest payment coming to you or your estate for the next 30 years and the principal of 1.8 million due to you in 30 years, okay? And what makes this strategy truly unique and powerful is you get your cash today in 2019, okay? If you're selling in 2019. But first, let's finish the first half of the strategy. You have your installment agreement with the dealer, but the dealer doesn't take title to the property. It passes through in a direct transfer to the end buyer with all warranties and representations. Whatever was contemplated between the parties is what's executed. From the buyer's perspective, it's if the buyer was never involved in the transaction. I want to emphasize that nothing changes for the buyer. There's no delay in the escrow, okay? Just like a 1031 exchange, okay? So now let's get you the money. This is the second half of the strategy. The money from the buyer goes into escrow. While the money is sitting in escrow, the dealer brings a third-party lender to the table. No one you've ever heard of before. It's a private lender who's going to loan you 95% of the proceeds of the transaction, 95% of the installment contract, okay? This loan is also for 30 years interest only, with a balloon payment due in 30 years. So when I say net, okay, so the installment contract is for 95% of the net sales proceeds. So in this transaction, net sales proceeds is before the loan is paid off. Okay, so the loan is involved in that, okay? Not paying off any of the debt. So now you have an interest payment coming to you for 30 years on the installment note with the dealer, and the interest payment going out on the loan for 30 years, for the 95% loan. These interest rates are calibrated to be a wash. The dealer's interest payment to you covers the interest payment to the lender. So the payments happen automatically. They have like a payment processing, escrow processing for the next 30 years. And so you don't have to write any checks. This is all happening automatically. Okay, so the dealer makes the deposit every month for the interest payment that gets credited to the seller, so they get the interest payment. And then that payment automatically gets moved to the lender, so the seller is making the payment on the loan. So it's a wash, okay? So there's no tax liability. So for the next 30 years, this is happening automatically for you. At the end of 30 years, you will have to pay your 95% loan back. But remember, you also have the principal of 1.8 million on the installment contract coming to you. So that covers what you owe and everything's a wash. So all you're left with paying your capital gains taxes in 30 years. Remember, the dealer is the one responsible to pay all of the loan payments every month on the loan that you signed, and it's a business investment loan. And the dealer is responsible for paying off the principal in the next 30 years. So you don't have the money that you're going to receive today, 2 to 5 days from the close of escrow on this transaction. You will never take one dime of that money to pay any of that loan or the principal. Okay? All right. 3 years. All right. So when do you get the money? You have the money within 3 to 5 days of closing. And who holds the money? You do. You're getting the money within 3 days of closing. You have it. You have total control, unlike other strategies. So the 1031 versus, we call it M453 monetized. 453 is the IRS code. So you got 1031 and 453. Sorry. So if you do a 1031 exchange, it's a lot cheaper in cost. Okay? That's if you have a client that wants to continue to hold on to investment property and accept rental income, 1031 is the way to go. All right? Monetized installment sale is for people that want to have their money in their pocket. Okay, maybe you may have a client that is basically living off of their Social Security and they need to have other ways of making money because the equity in their house isn't making them money. Of course they have equity, but it's not helping them with their living expenses. So you can also use the monetized installment sale for primary residence, and you can use it for businesses. Okay, so anything that any asset, airplane, anything that's got a price of $500,000 or more. Okay, so there's a lot of different situations where you can defer the tax for that. Unfortunately, you cannot no longer do personal property for a 1031 exchange as of last year. So you used to be able to, but now they don't allow it anymore. All right. So 1031 is cheaper. It's a known and familiar tax planning approach. If the owner keeps the property until they die, then the heirs receive a stepped up in basis and don't pay any capital gains taxes, right? For now. But they keep trying to get rid of stepped up in basis. So does everybody understand stepped up in basis? Okay. So if somebody acquires, let's say mom and dad pass away into this year, 2019, and you just acquired a home and your client says, okay, I want to go ahead and sell this home, then they can sell it and not have the capital gains taxes because they just acquired it, now they're selling it. But if they hold on to it for 10 years and it increases in value in 10 years, then of course they're going to pay the gain on the 10 years, but they don't have to pay the prior when they acquired it. Yes?
Excuse me. How do you determine the value? Because I've got a client right now, for example, who's got a property they're selling. They inherited it probably 10 years ago. And step up in basis, so everything's zero. You're looking back now at it and going, geez, how do I establish my basis for this property so I can calculate capital gain?
We usually tell them to ask the real estate agent, what was the value 10 years ago?
Well, there wasn't one because they inherited it.
No, but there was a value of the property that when they inherited it. So the best thing to do when you inherit a property is have an appraisal done on it. Right away. Someone passes away, do an appraisal. Anita, do you agree?
Yeah, I was gonna say the IRS, the only thing that they will accept, they will not accept the BPO as far as proof of basis for 10 years ago or even contemporaneous citizen. Have an appraisal, they can sell an appraisal of the property even if they have sold it. It just needs to be retroactive to the date of death.
So an appraiser might be able to help them with a price 10 years ago?
Absolutely.
Oh,
Yeah, ask an appraiser to give you a value of 10 years ago. So,
yeah, because nobody planned for that.
right, nobody planned.
Nobody looked at 10 years.
But if you're in the real estate world, then you should know to do an appraisal on the property. So that's what you guys got to know. Someone passes away, do an appraisal. Okay, that way you don't know what's going to happen in the future, but do an appraisal. Okay. Also, if you have any clients that put their children on title because they think that's the best thing to do, if you put your child on title, you gave them your tax bill. There's no stepped up in basis because the child's on title. So stay off a title, okay? Ask your tax advisor. I'm not a tax advisor. That's just my opinion. Stay off title. Because that way, when you pass away and your child acquires it, they're not getting the tax bill with the property. They get the stepped up in basis. Okay? So that's the reason you don't put the children on title. Create your trust. Do everything you're supposed to do outside of putting the kids on title. Okay? Now,
That basically an inheritance.
yeah, if you're on title, you didn't inherit it because you already owned it. Right?
Yes.
So, you don't get stepped up in basis. You get a nice little large tax bill with actually owning the property. So if you sold it, you have that large tax bill. But if you're not on title and you inherited it when they died, then now you have it. Now you get stepped up in basis. So your property, you know, like in my parents' case, they bought their property for $17,000, right? Back in the 60s. So by the time we got it, it was, you know, a few years ago. So it was around 600,000 in Milpitas, right? So if I was on title, I would have had that tax bill from the value of the 17,000. So because we were not on title, my parents had a trust. Now we acquired at 600,000. So when we sold it, we didn't have a capital gains problem. Does that make sense?
Yes.
Okay. All right. Anita can fill in wherever I'm forgetting to tell you guys. But so the M453. Any more questions, you guys?
Tell your parents to take you off.
Yeah. Tell your parents to take you off. You can be taken off. Okay. So get off if you did that. So M453 is what we call monetized installment sale, the short version. It's the only strategy I know where you can sell high today because we know the market's, I mean, we believe the market's going to be dropping, right? I mean, everyone says, no, it's not, or it just depends on who you're talking to, but nobody has that magic ball and know what's going to happen. But if we go with history, the market's going to drop, okay? So now's the time to sell, okay? But it's not necessarily the time to buy. And in an exchange, you only have 6 months to buy a replacement property. In a monetized installment sale, you can sell high today, and you can buy low whenever you feel like it. It could be 10 years from now. It could be, you know, it could be 6 months. There's no time period. You can hold on to your money and do with it when you want to do with it, okay? So no time requirement to purchase the new property, and the seller receives their full depreciation schedule, 27.5 years for residential property and 39 years for commercial properties. So again, in a monetized installment sale, you get your full depreciation schedule. You get to start over. On a 1031 exchange, there's an adjusted depreciation schedule, and that's another reason to talk to your tax advisor. And I'm going to be honest with you guys, I've talked to many tax advisors, and not one seems to match the other one when it comes to depreciation. Right, Anita? I mean, everybody has their own opinion, right? Can you get the IRS? I mean, how many people have called the IRS and asked a question and got an answer, and then you call the IRS back and you get a whole different answer? That's kind of how it is. So you got to have a tax advisor that is going to give you an opinion and then stand behind you and go to court with you. And that's why I know Anita from the industry, and I refer all of my clients to her because she's somebody that will go to bat for them. So there's an adjusted depreciation schedule when it comes to 1031 exchanges. And so the monetized installment sale is a great exit strategy. So now, we want to rescue a failing exchange. We have somebody that said they wanted to buy replacement property, and now they can't buy. We have actually one client existing right now that sold $8 million worth of property. He identified 2 replacement properties, one for $6 million and one for $2 million. Great. $6 million is going through just fine, but the $2 million falling apart. So he's going to actually finish his exchange for the $6 million and then do the monetized installment sale for the remaining $2 million. Okay? So what? Yes.
So here it says with the consent of the exchanger.
With the exchanger and the accommodator.
And the accommodator. So the 1031 accommodator. I am doing an exchange right now, and we're in trouble with the replacement property, and they refuse to release the funds.
Yep.
To another intermediary or to another
Yep.
third party, and they say that they have to wait until they pass 180 days to release the money.
Yeah, that's right. So that's my point. You have to choose an accommodator that's going to be willing to cooperate. And I hate to say it, but the main title company accommodators are not cooperating.
Why not?
Okay? They're not cooperating because they don't want to worry about the liability. Now, when a 1031 exchange fails, it converts to an installment sale. Okay? Any exchange that fails. If you started your exchange in 2018 and it fails in 2019, you get the funds in 2019, right? Now, what the main title companies are saying is, this is where their problem is. You end up selling your property, they give the money to the dealer. Okay, now they're out of the picture. They have no more control of it, right? But what they're saying is because the private lender has to give the taxpayer, the loan, they have no control. The title company has no control as if the taxpayer gets their money, and that's why they don't like it. Okay? Even though they're, you know, with the independence and, there's a lot of 1031 companies that cooperate. And that's why I started up my 1031 exchange company to help people get through these again. What happens, let me go through it here. Okay, so if you have an exchange that's failing, you have to move it before the 180th day. You can't go past the 180th day. If you were to move it to the monetize, it's gotta be in the 180 days. Or you can do it within the 45 days. Okay, if they say, oh, I don't find anything, let's go ahead and just do this other thing. So, you have to have consent of the accommodator. So, if you guys are setting up an exchange and you want to see if the accommodator will cooperate, call me. I'll send you the assumption agreement that they can look at it and see if the accommodator is willing to sign it. We have had situations with, like I said, the large accommodators, like you said, they just won't do it. They're not going to cooperate.
So for, Anita, the question, is there any legal recourse that you can use during the 180 days to have them release it?
Is Anita in here? I think she stepped out for a call. We'll ask her.
Well, but if you do that, and whoever, if the seller or the person, whoever sold, they release the funds to somebody and the seller is determined to have access.
No, yeah, because no, but that's not what she's saying. She's saying, will the accommodator, the title company accommodator, would they be willing to switch it to another accommodator or to the dealer, capital asset dealer? So Anita, we have a question for you.
Sure.
Go ahead.
So if the accommodator refuses to release or assign the money to another third party, is there any legal recourse that we can use during the 180 days?
There's legal recourse, it's not within, but it's gonna take longer than 180 days. Look at your contract, okay? Because
Your exchange agreement.
that's generally what they're looking at, is what did you agree to? And it was probably that they would not release the funds until the time expired.
Every accommodator agreement says that.
Absolutely, everyone that I've ever done. Now, their way to force them to do is going to take you more than 180 days, that you go to the courts and say, Your Honor, you know, they're not being reasonable, there's a, that this has to be, that for whatever reason it needs to be changed. Here in Santa Clara County, San Mateo County, Alameda County, San Francisco County, San Benito County, the courts are impacted. And it's going to take you more than 180 days to get a judge to make a decision.
Right.
So you have to go there ex parte, and then you're in litigation.
In my 25 years as an accommodator, and I did work for the title company accommodators, we did get one lawsuit where they wanted us to move the money, and then the legal counsel said, move it. We need to go to court.
Yeah.
So you could hire Anita to serve a threat of lawsuit against them and see if they'll move it.
And it just depends on who the accommodator, who the intermediary is,
Mhm.
whether or not it is. That's why it's really important when you start, if you're going to specialize in 1031 exchange, you know your intermediary, you know how flexible they are.
Yeah.
Right, because the agreement that we have specifically, it says with the consent of the exchanger. So the exchanger is my client.
Yep.
When they release it, they say, no, we cannot release it because that would be contracting with you.
Right.
So, and just be aware that once the funds go to your client, it is a foul 1031. They cannot have.
It can never go. So what's going to happen if we move it to the monetize, it still doesn't go to the client. It's going to go to the capital asset dealer. The client's still never going to touch the funds.
That's it. But
That's the key. Don't touch the money.
They refuse to transfer the money over, so they
Yeah.
are holding
Yeah.
on to the money.
That's not the first case that's been happening. So that's why you got to be careful when you're starting out. What's your goal here? What are we going to do? You have a question?
Yeah, I've never done the 1031 exchange,
Mhm.
but I wanted just to see, so an accommodator is someone like yourself,
Mhm.
right, that deals in 1031 exchanges,
Mhm.
and that person is certified, I guess?
Well, okay, there's really no requirement to become an accommodator. Basically, you have to have an exchange agreement. You got to have all the terms spelled out. The accommodator, if you're in business as an so anybody could be an accommodator. You could hire your friend to accommodate for you, but you gotta have the exchange agreement, and they gotta know, they gotta be able to guide you, right? They gotta know the rules to the 1031, but, you just wanna make sure, like I said, the strength is title companies if you're gonna go 1031, but there's also the downfalls. They're not gonna let the money move if your client can't move forward, okay? So there's no schooling for accommodator, there's no licensing for accommodator. You wanna be bonded and insured, or you wanna know this person, use the second signer accounts. There's a lot of protections. So that's what I'm here for, you guys, to ask questions, and I can help guide you. I'm not the attorney. Every time, like I said, if we need an attorney, we go to Anita, okay? Then we can take care of her.
Strange, but if you own a home here,
Mhm.
and you own a investment property, let's say in Merced, a lot less than property here, can you 1031 exchange the Merced property to your own home?
No.
You can do
No.
that.
You cannot, so what she's saying, if she sells an investment property in Merced, can she pay off her primary residence? No, they won't let you do that. Not in a 1031 exchange, okay? So, in a monetized, the answer is no also, but there's a way to get around it, okay? So, you have to talk to us on that. So, we want to make sure that you do everything within the guidelines, nothing outside the box. We don't ever want to expose you to audit, okay? But we're going to tell you, what we like to do is we like to talk to you and your tax advisor. And when we talk to the tax advisor, we say, okay, this is what we're doing. Do you like it? Are you ready to back up your client? And they say yay or nay, okay? And it's usually yay. We'll give them enough information where they're okay with it, yes.
But you can move to the Merced house and live there for 2 years.
Then you live there for 2 years and you sell it and you don't even get the full exclusion. It depends on how much it's appreciated, and do you want to spend that time of your life doing that? Right? I mean, it's all it all depends on the client's goals.
So maybe the investment property is not in the city, maybe in Palo Alto.
Correct. That's right. That's right. Yeah. If it's something that a client wants to do and they want to uproot and move to the other property, there's options. But like I said, it's Anita, go ahead.
Just when you start getting very creative, general rule of tax, if you start getting very creative, at some point, the logic is going to fall. But what I want is just, if you're doing 1031 exchanges and you're moving one county to another or one state to another, you also have to consider, what does the state allow? For example, we're just dealing with a client right now that did 1031 exchange from California property to New York property. And it's interesting that there's different, not every state follows federal law. In California, we have what's called partial compliance. Some things we follow, some things we don't. And when you start going to different states, you want to know, will that 1031, the IRS will say, yes, this is proper. But what is the state follow? And especially to know when you go to sell it, what does that state follow? So just be aware that if you are in California, you know, we all know California tax law. When you start going out of state, that state might not follow the 1031, and part of that may be taxable. So just as you're leading your clients, if you're a professional, just be aware.
What are the typical fees for?
Oh, the
service?
fees for monetized?
Yes, for
Okay.
services.
The typical 1031 exchange fees are anywhere from $800 to $1,000. That's pretty inexpensive to do a 1031 exchange. Of course, unless you're doing reversed and all that. It's different.
Regardless of the amount of the property.
Yep, the monetized installment sale is 6.7% of the net sales proceeds. Okay, so it's a lot larger cost than a 1031 exchange, but there's a lot of flexibility. Okay, 6.7. All right, we're almost out of time here, so let me finish going through these real quick. So the exchange agreement is amended if you're rescuing the exchange to provide for the M453 sale. Instead of a lump sum payment of the sales proceeds to the seller, would-be exchanger, it goes to the capital asset dealer, becomes the successor of the 1031 accommodator, and converts the exchange agreement to a M453 transaction. So the MISP, which is another word for M453 loan, can now be funded to the seller. So the key is to watch your client's goals, okay? That's what we're here to help you do that. So consider using the monetized installment sale in any property that's worth $500,000 or more. So if you own property in Tracy and that, it's not worth $500,000, you can actually bundle properties. Okay, you can lump them together. We start out as a 1031 exchange, we'll bundle them together and then move them to the monetized. It helps for capital gains, cancellation of debt, debt over basis, depreciation recapture. Not everybody understands that when they own investment property and they've been depreciating it. When you sell it, you gotta pay that back, 25% depreciation back, okay? So that becomes a big tax bill in itself. We help with failing 1031 exchanges, or if you have somebody that has already carried back a note for their buyer and they're gonna get paid off and they don't wanna pay the tax, you can defer the tax bill for 30 years. The only thing it doesn't work for is listed securities through a public exchange, but if you have somebody with listed securities, we have a whole nother tax strategy for you. So anybody can use this, business entities, corporation, LLCs, partnerships, individuals. We had a professional practice, a dental office, yes?
Yeah, I have a question. Why do you use the monetized installment sale in a property more than 500,000?
Why did I use a monetized?
Can you use it for something below, like 450?
Yes. Yes, I have to get special permission from the capital asset dealer, but I have been able to go as low as 430. Okay, so it depends on, I have to get special permission with that. So, we're almost finished. So, everybody can, individuals could use this, corporations, LLCs. We had a professional practice, we had a dental office and a law firm sell their business and deferred capital gains for 30 years. Real estate, whether held for business or investment purpose. Personal residence, fractional interest. So if you have husband and wife, maybe they're divorcing and husband wants to do this, wife doesn't, you can do it as long as the value's there. Mineral rights, you can even do this with cryptocurrency, defer the tax on cryptocurrency. Contract rights, franchise agreements, license agreements, long-term leases, 30 years or more remaining, art or antique collections, aircraft, watercraft, classic automobiles, but not including sales by someone in an ordinary course of business as a dealer. So like a car dealership. Car dealership is buying cars to sell cars. Okay, you can't 1031 them and you can't use for monetized. You don't want to, dealers have different rules. Real estate flippers, you must own the property for a year and a day to receive long-term capital gains taxes. So flippers, there's different strategies, okay? Flippers are really exposed on a 1031 exchange. On a monetized, they have a little bit of different strategies, so they might be a little bit, the tax person might be a little bit more comfortable using the monetized for flippers. So I am out of time, you guys. Here's my information. I call myself a tax strategist because I help with 1031 exchanges and the monetized. Yes.
Quick question. So you keep saying defer for 30 years. What do you do in 30 years?
Okay, if your tax bill today is $200,000, in 30 years, your tax bill is $200,000. Well, okay, but we don't know what the capital gains rate is going to be in 30 years, right? So if the capital gains rate goes higher, your tax bill is going to get higher just because the capital gains rate went up. But if the capital gains rate goes down, your tax bill is going to be lower.
So you still have to pay it.
You're still going to pay it, but in 30 years. The goal is to take the money that you would normally give to the IRS. So if you had a $200,000 tax bill, instead of giving that $200,000 to the IRS today, invest it. Okay, get a financial advisor. Scott's my business partner, and he is in the financial world. Okay, so he helps a lot of our clients. So the goal is to take that $200,000, put it into an investment in 30 years. What will you get? 30 years, $200,000.
1.6 million at 7%.
In 30 years.
In 30 years.
So in other words, those 200,000 though, you're not utilizing.
You can't.
There's so many strategies.
Right. So
the reason why I jumped up here at the end is to let you know. Hand me the business cards. I will send you the IRS memorandum. I will send you information in the next few days. So I'll get that to you. We work together. When it's busy season, like we're cranking into there right now, she manages the contracts, and I'm out in the field. So if you have clients that want to sit down, look at the numbers, make sure it's a good fit, you're more likely to see me. We go out, again, when it's down time enough where she can be out in the field more. But most likely you'll see me. So feel free to I'll stick around, hand me your credit cards, business cards, and we'll be good to go.
We actually have a poll going around that we're collecting business cards. So if you have not put it in there, there's actually a raffle going on as well. So you definitely want to put your business card in there.
Okay, so the goal is if you have a $200,000, or let's just say $100,000 tax bill, take 25% of that and put it away. 25,000. Put it into something that's going to grow to the 200,000, and it will. It will grow to the $200,000 tax bill. So now you have the remaining 75,000. You can do whatever you want to do.
So what if
with
you
it.
want to pay that off sooner and get out of it?
You can pay it off sooner, but who wants to? I mean, I've never seen a reason to do it, but you can contact the capital asset dealer and see if they can break it. If in the future you take a loss on something and offset the gain, there's so many different things that we can do it. Yeah.
What if you passed away in the middle of the
If you pass away, this belongs to your heirs. Okay, so you got to tell them tax bill's coming. Let's keep that 25%. Don't touch that account. The bill's coming. I know. Yes.
So you're 29 or 30. Okay, you're already gone. Your heirs have this. What is the mechanism, or what is the method that your heirs are going to remember? I'm sure the IRS already remember.
You're going to okay, I already know what you're getting to. How are you going to remember this? How your heirs going to remember? Your heirs need to be filing your tax return every year for the next 30 years. They're not going to forget because they're filing a tax return. Because they have to claim the income in and they're claiming the income out for the next 30 years. Okay, so that's why we talk to the tax advisors. We make sure everybody's in line, let everybody know what part they need to play, and that it can be done, and it's very, very simple. All right.
Well, please join me. Thank Ruth. Thanks, Ruth, for doing this for us today. It's really good information. So I'm sure there's a lot more questions, so she's going to be sticking around afterwards, or you can contact her. Her information's up.
Scott's here too.
Scott's here as well. Her business card is there. Also, Anita. I want to thank Anita being here as well. Her business card is also up in the front. She's part of the affiliate committee as well. So go talk to these ladies. What else are we going to do? Oh, so announcement. We have the next Brunch and Learn is gonna be, what's the date? It's May 17th. So mark your calendar. It's gonna be presented. It's gonna be about economic forecast, presented by Scott Anderson, Executive Vice President and Chief Economist at Bank of the West. So you do not want to miss that one. He's going to tell us what's going on with the market. We all want to know how to plan our business accordingly. And also on May 7th, Tuesday, 8:30 to 10:30, breakfast in the park, the Harrier Park. They have an event going on. You can register at score.com/breakfast. And if anybody want to take a picture of this, I don't think we have flyers in there. Oh, we have flyers over there. If you have any questions, talk to Jaime over there. We would love to have you out there. It's a great event. It's a great way to network with other real estate agents. You never know when you're going to be in your buyers want to buy that listings, right? So you want to know the seller's agent. So it's better to know more realtors in our network. We do have a raffle. Yeah, so here's Keith.